All right, well, welcome back. Welcome back. I am Marziti, and we are doing stocks, futures, options, compare, contrast. This is part two of the series. And let's see, let me just jump through where we were as we'll whip through this. Okay. Yeah, we finished up on risk. Now let's talk about the upfront capital. Now, the upfront capital on the cost of stock is just that. If Acme Widgets is going for 30 bucks, a share costs 30 bucks. Margin, however, on the futures is quite different. I'm going to come back to that in just a well, no, we'll go ahead and do it now. As I talked about earlier in the risk, when you are in futures, you put up what's called margin, which is your collateral to trade the market. Now, that margin requirement varies by broker and by ticker. It varies completely, dramatically, as I'll show you in a few moments, about margin requirements there. But again, this is simply collateral that you are putting up. It does not mean you can lose all of your collateral and more if you do not manage your trades properly. Options come in as a cheap way in most cases. Options come in as a cheaper way to play the market. But again, you can actually make money not only on your outcome of your option, whether the option itself won or lost, but just by taking an option in what we call premium. So it can range from less than $1 to $1,500 more. It can range up to $2,000 or whatever. I'll show you some of that as well. Let's just take a look at margins. I have pictures from, this is a spreadsheet here. This spreadsheet at the bottom is from Tradeovate. And the top one is from Thinkorswim, TD Ameritrade, which is at the time, as I'm making this recording in 2024, they have been bought by Schwab, and so they will be moving to Schwab. But at any rate, if I wanted to trade the ES, the S&P 500 futures, at TD Ameritrade, I would have to have in my account almost $15,000 per contract. Now, if you know anything about futures, you'll know that 1 point move on the S&P on the ES rather is about 50 bucks. So that's a lot of margin to put up for $50 increments. But that's just the way it is, and that's what's called the full margin. Because TD Ameritrade, Schwab do not delineate, they don't make any difference between day trading in and out of a contract the same day versus holding it for 6 months. None whatsoever. Tradeovate, on the other hand, has what's called a day rate, which means you're in and you're out the same day before market closes at 5 p.m. Eastern Standard. So here's the ES down here. And whatever. I was going to get a little fancy tool out, but let's just keep moving. So the ES here is the same exact contract, exact same thing, except it's on Tradeovate instead of TD Ameritrade. And we'll see that they only want $500 per contract to get into a trade on the ES. So that's a huge difference from the $15,000 above it, $500 in Tradeovate versus near $15,000 on TD Ameritrade, Schwab. However, if you want to hold this contract overnight past 5 p.m. Eastern Standard, then you will have to have almost $13,000 in your account to hold that one contract. So if you're trading 5 contracts, well, that's 13,000 times 5 per contract, kind of thing. Same thing here with TD Ameritrade. So they have an intraday rate and then they have an overnight rate. Schwab Ameritrade does not have this day rate program, so they just charge you $15,000 per contract, whether you're day trading it or holding it overnight. They don't care. So that's called margin. And again, remember that you can lose more than you put up on futures. You just have to make sure you manage your trade, knowing what your broker's liquidation policy is, and knowing how to place your stops and things like that into your trade. They are margin futures as a whole are fairly safe to trade. So long as you manage the trade effectively, it's not a big deal. It's fairly simple. You would do stocks the same way. You would put stops in on your stocks in many cases. And the main thing to understand, though, is that, again, it's learning to manage the trade with stops, what your broker's liquidation policy and all that kind of stuff is. Some of these can be fairly not choppy, wrong word. Some of these can be fairly cheap to get into. The E-mini, which is, we just call that the E-mini, but there is a child of the E-mini called the Micro ES. The Micro ES does everything in a tenth. So here they wanted $500 per contract. Here the micros move $50 a contract. The same thing on TD Ameritrade. You'd have to put up we'll call it $1,500 a contract if you wanted to trade the MES. But bear in mind that where the ES moves $50 per point, the MES moves $5 a point because everything's a tenth. Similarly, looking at the NASDAQ, the NASDAQ's a little more volatile, so they want $1,000 intraday, and it moves $20 a point versus $100 a day, and it moves $2 a point. So this is definitely understanding margins, and this margin varies with every single contract, with every single ticker. We've got, natural gas. We've got the Russell. That's not natural gas. That's the NASDAQ, excuse me. NG is the natural gas. Anyway, so we've got the Russell, we've got the NASDAQ, we've got the ES. There's all kinds of other stuff. There's crude oil. You can trade on crude oil. You can trade wheat. You can trade all kinds of things in the futures. Another advantage about the futures is they're also open 23 hours a day, Monday through Friday, whereas the traditional stock market is open from 9:30 Eastern till 4 p.m. Eastern for 6.5 hours. Futures are open 23. Everything except for crypto is closed on the weekends. Option costing, whoa, man, that is quite a lot of difference. So let's just kind of work through some of this. First of all, we're looking at, where's my pointer thingy? And let's get a color. I still don't have it. Whoops. All right, well, that's not going to work. Anyway, so options, now that's just going to bug me to no end. Why doesn't that work? Am I in eraser mode? Whatever. All right, well, that's broke. We are looking at AMD. At the time that I took this screenshot, AMD was trading for $178.70. We're going to round that in our head to 180 bucks. So we're going to say 180 bucks. Now, notice that this contract here expires in 3 days. When I took this picture, it was April the 2nd. So this contract will expire and come to its conclusion in 3 days. If you wanted to go, if you thought that AMD was going to go up in price, you might buy or take the ask on AMD at $2.52. Options do things in 100s, so we're going to multiply that times 100. So $2.52 becomes $200.52. Now, and that is at what we would call a delta 43. If the price on the option, if in fact that, let's say that it goes up in price, then the contract would go up $43. It says 43 cents times 100, $43. So you'd get into the trade at $252. And if it does in fact go up $1, your option would go from 252 to what, 295. And you could sell it there if you wanted to and capture that $43 move. Now, however, let's say we're in it for a longer play and we're going to go out 45 days. Well, the 180 here, instead of up here is $2.52, here it's $13.05, or times 100, $1,305. So you can see options get completely different. The price of an option depends on the time, 3 days versus 45 days. It depends on what line you take here. We call these strike prices. And you pick a strike based on where you think it's going to go and all that kind of stuff. So as you can see, options are way more complicated, but you can get into an option. If you thought there was actually a remote chance that AMD could reach $192 in the next 3 days, you could get into this contract for $20, a whopping $20. And if it does, as it moves, each time it moves through the chain, you'd first make 43, then you'd make 32, then you'd make 22, 14, and so on. So you can definitely see that you can make a lot of money as it starts adding this, then adds that, then adds that, then so on and so on. So anyway, that is options costing. Can be, fairly steep learning curve in the very beginning, which is another reason that we tell people if you can't read the basic chart right now, you got no business going into options. And I'm not trying to slam anybody. I'm not trying to put anybody down. I'm saying this is complicated. You need to be able to read a chart first before you think about options, in my opinion. All right, let's move on to hold time. And so hold time is when we talk about stocks, ETFs, and so forth, and I'm just going to say stocks from now on. Do you want to hold your stock for a short term or a long term? You can do either one. You can do either one. It's totally up to you what you want to do. Futures will be expensive to hold long term because you've got to pay that full margin. Let's go back and look at that. Even on a discount platform like Tradeovate, to hold that contract past 1 day, you got to have $13,000 in your account per contract. So holding this is expensive for a long period of time. And the options, as we just saw, going back again a slide, if you're just holding it for 3 days, it costs you $252. If you hold it for 45 days, it costs you $1,300. Okay? So, and again, now as we move down here to hold overnight, much like I just said, depends on your goal. Futures are expensive. This simple but varies closed to open. If you have it's real simple. If a stock closed at $30 today and it opens up at $31 tomorrow, okay, that's great. If you're in the stock at 30 and it opens up tomorrow at $29, because remember, stocks only trade 6.5 hours. So since they only trade 6.5 hours, well, that leaves us 17.5 hours where all kinds of craziness could happen and affect what that stock's going to open at the next day. So that's the reason I say it varies from close until next open. Nonetheless, unless some major catastrophe happens or you have an earnings report, this is usually not a big problem. Usually not a big problem with stocks, but there are certain situations that can make them go crazy. All right. Now let's talk about the return per capital employed. And what we're talking about here, when we talk about capital employed, we're talking about how much money do you have to put up versus how much you get for a move. Now, I'm going to actually work with the S&P on this, but so we're actually going to look at multiple different things here. Let's kind of get into that. Let's just say that you wanted to trade the actual S&P. And we're only looking for a single 1-point move in it. So the S&P at the time I made this video was 5,250. Well, you have to buy the S&P in lots of 100. So you would have to put up $525,000. Now, again, you got stocks like AMD, which are $180 and all that kind of stuff. But I'm choosing the S&P to illustrate these numbers. If the S&P moves 1 point, it moves from 5,250 to 5,251, you would make $100. If it moved against you, you would lose $100. Okay. However, let's say it moved 1 point in your favor, and you're like, woohoo, I made $100. Well, you had to put up $500,000 to make $100, which is a return on your capital of 0.02%. You didn't even make 1%. You didn't even make 0.1%. You made 0.02%. Okay. Well, now, granted, you have some stocks like AMD that say they're $170 right now, roughly, whatever. And if it moves and let's just bring the calculator up on that again. Let's say that AMD moves by call it 170 just to make the math. So let's say it moves in your favor 1 point, so that it moves to 171 divided by 170. Well, okay, you made 0.05 for that. Or wait, you didn't even make that. Well, gosh. So we'll round that, call that 6. You made, 0.006. So, not so. Stock moving, buying and holding stock is usually a longer term thing for many people. Now, there is a category called penny stocks, and that's a totally different breed. You trade penny stocks. You're going to trade the price action on the chart much the same. But when we talk about penny stocks, we're talking about something that is $5 or less. Now, I know they call them penny stocks, but we typically in the U.S. market refer to them as $5 or less as a penny stock. And that being the case, you really don't have a lot of money. If a stock is going for $1 and it moves 10 cents, well, that's 10% return. That's not bad. And that can happen in the penny stocks. But there's you trade penny stocks, though. You have to look at them slightly different. And some of the moderators are very well versed on penny stocks. And if you want to come into the Bullish Bears Forum and talk about penny stocks, we definitely have got the people there that can talk to you about it. Now, futures depends. Here's broker A versus broker B. You may remember these numbers from before. For example, this is Trade-O-Vate. This is TD Ameritrade or Schwab. This is the exact same trade. But it depends on the broker and how much margin you have to put up. So if you're on Trade-O-Vate and you only got to put up $500, and it moves 1 point in your direction on the ES, which is the S&P version or the futures version of the S&P, well, you made a nice 10% move. If you're trading the ES on TD Ameritrade, Schwab, because you got to put up $16,000, that 1 point still gets you that same $50, but you made 0.31% on the trade as far as your return on the capital you had to put into the account to make it happen. Well, now, when we talk about options, as you saw back here, let me just roll back here real quick. Remember, all these different strikes have got all these different crazy numbers and monies and stuff like that. So I just picked some very close to what it was trading at the moment when I was putting all this together. But at the time when I put this together here, an option on the SPX itself, on the stock, was selling for, or you'd have to pay $650 to get into that trade. If it moved 1 point in your favor, you'd make $40. giving you a 6.15 return. Okay. Well, there's also options on the ES. Just like there's options on the SPX, there's options on the ES. Here you'd have to put up $887. 1 point would net you $23 for a 2.59%. So you can see there's a lot of different crazy numbers here, kind of things. The most stable places to be, in my opinion, and that's just all it is my opinion, is if you want to trade futures, come to a discount broker like Trade-Ovate. If you want to trade stocks, it depends on how fast you want to go. If you want to slow and steady, sure, you can get into an AMD, a Tesla, a Meta, Cisco, General Electric, whatever, and it's going to be slow going because you're not making a lot of money. But I mean, of course, the stocks will be a lot less as well, but they don't move as much either sometimes. I mean, they may. I mean, like Tesla can be a humongous roller coaster, but that goes both ways. You know, you can make a lot of money, you can lose a lot of money. But if you want to trade futures, I would suggest you look into Trade-Ovate. If you want to trade stocks, if you're going to take slow and steady, you know, you've got your good name brands there, or you can look into penny stocks. But again, my opinion. All right. Let's take a look at price movement here. There's really nothing specific to talk about, no slides here, other than price movement on a stock is linear. Goes up $1, you made $1. AMD goes from 170 to 171, you made $1. It's that simple. Futures, there's a multiplier, and the multiplier depends on the ticker that you're using. In other words, the ES, which is the futures version of the S&P, 1 point equals $50. If you're on the micros, 1 point equals $5. However, on the NASDAQ, which, and by the way, if you're trying to relate this to stocks, you would know the S&P on general stocks as the SPY, S-P-Y. If you're on the NASDAQ, you would know it as the QQQ. Now, but if you're trading the futures version, the NQ, the multiplier is 20. So 1 point move on the NQ is $20. On the micro NQ is $2. It's still linear, there's just a multiplier there. Now this is where options get very interesting. Options are exponential. Let's go back quite a few slides. Remember what I was talking about here. Let's say that you bought into this here for $252. You think AMD is going to go long, going to go up in value, and you know, over the next couple days, and you bought this $252 contract, and you think it's going to go to 190 for whatever reason. You think it's going to go to 190. Well, as it moves from 180 to 182.5, you add 43 cents. As it goes to 185, you add another 32 cents, and so on. 22 cents, 14 cents, 9 cents. And so options are exponential. But again, that goes both ways. Where am I? I've lost myself. Talking about price movement. Yeah, that goes both ways. You can also lose very quickly in options if it goes against you. So it's exponential up, it's exponential down. Again, more experienced traders need to be here with options. How are things related? Are things related? Let's talk about that for just a second here. Let's start. I want to do some quick comparisons here, and I'm going to jump over this slide here. Here is the SPX. At the time that I made the slide, it was roughly 52.58. I'm rounding. 52.58. Well, isn't the ES the futures version of the SPX? Shouldn't it be 52.58? No. because this is independently traded from this. This is this has its own, this is a ticker here, and you trade it and people can buy and sell it. This is based on this, but it's also independently traded. Now, as you can see, the charts are very similar, very, very similar, but there is a little bit of difference called drift between these two. Well, here's the SPY, which is an ETF of the SPX. Well, again, we see that same issue, is that it's not quite the same. Now, the SPY is a tenth of the SPX, so 525.8 would be 526 if we rounded it. But instead of 526, it's 524. Again, independently traded. Now, there are behind-the-scene moves that will try to nudge these latter two into alignment back to the SPX. They will try and nudge them. But during the day or over periods of time, these two will drift away from this until they get realigned. All right? And a lot of times it just, in the case of the ES, a lot of times it just simply is the matter of when the contracts roll to the next version. You buy a ES contract for a certain month, and then at the end of that particular month, it's done, it's run its course, move on to the next contract, and that will be a contract for the next 3-4 months down the road. Anyway, so even though they're all based, both of these here, the ES and the SPY, are derived from the SPX, they can drift from it a little bit. Let me go back. Let's take a look at here. Futures close but independent. Options, when you go back and look at that options chain as far as the alignment to the ticker, options are based on the movement of the underlying. Remember I talked about underlying earlier was the underlying stock. And what was that? So if you took an option on AMD, the changes in the chain, let me just roll back a couple more slides here. This chain can move. There are other things in here, like Vega is also factored into the price, and it can change. For example, if something, incredibly exciting comes out about AMD, and people start swarming in there, buying it up, well, this could increase the demand for these options to go up, and therefore Vega goes up, which when it gets added in, changes all these different numbers. So options can really, really change a lot on what's going on. All right, the trade direction. Let's talk about that for just a second here with stocks, ETFs, well, not mutual funds, but with stocks and ETFs. You can go long, you just buy them and they're yours. You own those shares. Shorting a stock, however, is quite different. Remember, if you short a stock, you don't actually have the stock. And because you don't have the stock, you have to borrow the stock. Now, your broker will try and middleman to find someone who's willing to let their stocks be borrowed, to loan it to you so that you can short that stock. You have to return that stock, and if you hold that stock overnight, you have to pay the person who loaned you the stock a little bit of interest. It's usually like an annualized 8, 9, 10% annualized. So, I mean, it's pennies per share each night. But the person that let you borrow their stock is entitled to some compensation because they let you borrow their stock. So if you're shorting it within the day, you're in and you're out within the day, you don't have to pay anything. But if you're going to hold this stock overnight, then you have to pay a little bit per share to the person that's loaning you your share. And again, you won't know the person on the other end of this. Your broker will do all this for you. They'll just tell you that some stocks are easy to borrow, some are hard to borrow, that kind of thing. Again, your broker will have some way of telling you all that kind of stuff. Moving now to futures. Well, futures are the simplest one here. You're either long or you're short. It's that simple. And lastly, with options, combinations. Oh my gosh, you can make, as we talked about earlier, you can go long, you can go short, you can stay in the middle, you can anticipate a breakout, but you don't know which way. There's so many ways you can configure an options, it's crazy. So, at any rate, different things to consider there. But a lot of people talk about shorting the stock and don't understand about this borrowing concept. And so that's why we talk about that here. All righty. Let's talk about liquidity. I may run a little bit longer. We're really kind of close to the end. Liquidity means that there's a lot of buying and selling. There's a lot of buying and selling. Now, sometimes we're talking about a stock. Sometimes we're talking about a price point. So when we talk about a stock or a future, these are easy. We're looking for the ones that are very liquid, which if there's a lot of buying and selling, it means it's easy for you to get in and out of a trade. The last thing you want to be in, and let's just jump on over here and look at this. Here's a list of big mega firms. Big mega firms. You know, Affirm, AMD, Amazon, Coin, Disney, Google, Meta, and so on, Tesla. This is their daily volume the day that I took this picture. Millions of shares traded hands. Millions. Here's Tesla traded over 30 million shares in one day. AMD, 23 million shares in one day. That's good volume. You can get in and out. You can buy and sell stocks here, no problem. Here's some penny stocks, though, and it doesn't have to be a penny stock, any stock. You go look at its daily volume, and you can see really crazy numbers. Now, here's a penny stock, AAU, did over 1 million shares in one day. Well, fantastic for them. Here, on the other hand, AASP, they only did 100 shares in one day. Well, what if you got 500 shares and you want to sell it? There's nobody interested in buying it. What does that mean? It means you get stuck. You get stuck. You can't get out of the trade. You got 500 shares you want to trade, and maybe there's no buyer there. You'll have to lower your price so much at some point so that somebody will finally say, I'll take it for that. I'm not going to take it for, 22 cents, but I will take it for 10 cents. And you're like, oh my gosh. Some of these, even down here, had none, not any at all. So when you look to trade any stock or future, you want to ensure there is volume in there. I'm going to pick a number typically of at least 100,000 average a day, but I like to personally, I prefer millions. Now, options are different. Options have two things called volume and open interest. Remember, volume is what happens today and only today. Let's say we're at, lunchtime, market time, or whatever. These numbers will continue to grow throughout the day. They start every day at market open. For me, it's 9:30 Eastern Standard. So at 9:30, these numbers will, or 9:29, these numbers will all be zero. And as there are transactions throughout the day, these numbers will just go up 1, 2, 3, 4, 5, 6, plus, just keep growing and growing and growing. That's volume. At the end of the day, that's what it is. It'll be reset to zero tomorrow morning. Open interest, on the other hand, is the number of people that have an option. They opened it yesterday or before, and it is still open. Remember, you can hold on to an option for years. You can buy an option that goes out for a year. We call those leaps. So let's say that you're in an option, somebody could buy an option and be in it for 45 days. Well, as long as they're in that option, that counts towards open interest. They have not closed it. They're still in it, and this is the number as of close yesterday. As of close yesterday. This number will not change today at all, not one. This number will not change at all today. At the end of the day, they'll go back and they'll look at all the new entries or changes that happened during the day, and they'll update this number overnight, and then when market opens tomorrow morning, this number will be updated. The point being, though, is if you want to get into an option, the last place that you want to get into are some of these places that have zeros in them, because that tells you that nobody's interested in that. And if you want to close your option, you can get into the option. You can get into it typically, but you may not be able to get out of it if you want to get out of it. So anyway, that's options. Two more things to talk about here. Let's talk about the bid and the ask spread. When you buy, you typically pay at the ask. When you sell, you typically sell on the bid. Here we see a 2-penny difference between the two. 2 pennies. Okay, that's what we call a tight bid-ask spread. 3 cents here, 3 cents here, 2 cents. All these are good. I don't see any major problems with any of these right here. Here's Tesla. It's 5 cents. But considering how much Tesla changes, that's fine. That's fine. What we don't want is, and it's written up here, when we say we refer to it as the bid ask. That means if you bought this stock right now at the time I took this picture, you would have paid 40 cents a share. If you needed to sell it within 5 minutes or whatever, though, you would only be able to get back 17 cents. So let's say that you bought 100 shares, then you would have bought 100 shares, you would have paid 40 bucks, but if for some reason you're like, oh, that was a bad trade, I shouldn't have done that, and you go to click the sell button, you're only going to get 17 bucks back out of your 40. That is a horrible bid-ask spread. Horrible. So that's something that we want to look at when we are looking about taking a trade as well, is the bid-ask spread. You will also have a bid-ask spread on futures. And here again, you'll also see here's bid-ask spread on options. 59 cents versus 61 cents. That's a good spread. But notice down here, we got some zeros. You could buy into this, but there's nobody even making an offer to get you out of it. So we want to look at that too. Notice as we go back in here, though, some of these spreads, though, this is $1.10 wide. That's, that's kind of big. That's kind of big. But again, we have bid-ask spread on options as well. Finally, what is optionable as we wind this down? You can find that of the big major stocks, and some penny stocks and stuff like that as well, many of them are optionable. What varies in the optional is how long a contract can run. For example, if you took an option on the SPY, the SPY, you can do what's called a 0 day. It expires at the end of the day, and then everything washes out on that option. Other options, though, are monthly, or some can just do every Friday, and some only do quarterly. When you buy an option on a stock, it is typically reflective of 100 shares, which is why when we say 59 cents back here, we actually are saying $59 because it's times 100. So you're actually trading essentially 100 shares of stock. With your option, you've bought the right to trade 100 shares of stock without actually owning the stock until your option you close it or it expires or whatever. Options on futures, that's quite a different story. This depends. Remember how much I said the ES? Here it is, the ES. The ES, 1 point on the ES is $50, okay? Therefore, one option on the ES is for 50 shares. The same thing with the NASDAQ. The NASDAQ, 1 point on the NASDAQ is $20. Therefore, when you buy an option on the NASDAQ, it's for 20 shares. So this varies a lot. This varies a tremendous amount. So, at any rate, so again, so the simplest place to be, in my opinion, the simplest place is if you're a beginner. As we wind this down, we got stocks and we got futures, and I'm going to tell you to stay away from options if you're a beginner. The beauty of stocks, it's totally linear. Goes up $1, you're up $1. Goes down $1, you're down $1. The downside to it is you can only go in one direction typically, and that is long. Unless you want to get into borrowing, and then you got to get into margin and all that kind of stuff with your broker, blah, blah, blah. I would tell you just to stay away from that. Just look for stocks that you think that they're going to go up in value, and you can do that. You can go over to penny stocks, you can go to big stocks, you can go all kinds of places. This is the simplest place to do things. Futures, again, little bit of a learning curve with it because there's a little bit more complexity to it because of ticker sizes, lots of 50, lots of 20s and stuff like that. But if you understand stocks, within 15 minutes you'll understand futures. The only thing you need to know beyond that is risk. You've got to learn risk management. You've got to learn risk management. As long as you understand your risk management, futures are a great place to be. And so I would say learn a little bit about stocks, then maybe move over to futures. And then if you really, really want to get advanced, you can certainly learn about options. That brings us to a close. I hope this has helped you guys. I hope it's been informative. Of course, as usual, I'm more than happy to answer questions if you have some. And, of course, all the moderators on the Bullish Bears website or in the Discord, I should say actually on the Discord, more than happy to come to your rescue, answer questions and things like that. And all in all, I think I've enjoyed doing this. I hope you guys have gotten something out of it. And we'll look forward to seeing you over in the Bullish Bears Discord, and we'll do some trading. We'll see you guys. Y'all have a good one. Bye-bye.